Trading with MACD, Moving Average Convergence and Divergence. I hope everybody's having a delightful evening, and I'd like to welcome you to our class. Now, for those of you that are joining us for the first time, ETX is a regulated provider, so I'm therefore required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risks or seek independent advice if necessary. ETX Capital provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only and is not intended to be a personal recommendation or construed as advice. All traders must understand that there's a high element of randomness to the markets. Therefore, they will experience both winning and losing trades while following a trading strategy. Different traders following the same strategy will achieve different levels of performance. Past performance is not an indicator of future results. Now, for those of you that don't know much about ETX, we are a regulated provider. We are a fast-growing financial services company based in London. We are authorized by the FCA, that's the Financial Conduct Authority. And at present, binary options are not a regulated product, but will be so effective in January of 2018. And we are also a member firm of the London Stock Exchange. When you trade with us at ETX, you can start out with the ETX binary options platform, which is a great place to start learning how the markets move and how to start using analysis and charts and all that kind of stuff. Because when you're trading on ETX binary platform, the only risk you take is the dollar amount you type into the screen, because there is no leverage or margin when you're trading binary options, and you're simply predicting if an asset will go up or down. Once you've got a handle on the financial markets and how prices operate and how assets move, you can move over or at any time start with our ETX Pro platform. That's our most advanced or our most state-of-the-art platform. It is our favorite platform, and that's simply you log on and you can start trading CFDs, Forex, spread betting if you're in London. You can trade a wide variety of assets. You'll get the lowest spreads. You can use all different types of order entries, and you have fully customizable charts. And for those of you who want the ultimate experience, or those of you who want a professional trading or have the experience, you can download our MT4 platform, and that'll allow you to trade, do everything right on your own computer, and allow you to attach expert advisors to your trading platform, use our advanced charts, and you can also use the MT4 platform to start building your own automated trading, generate your own signals and alerts. And you can trade on all of these, none of these, one of these, however you want to do. Just contact customer support and they'll make sure you get everything you need. But most people are trading, or most of our traders are trading on our ETX Trader Pro, our newest platform that gives you everything you need in one concise, easy screen. Now, tonight's webinar is being recorded. If you ever want to go back and see a recorded version of this, just use the same link you used to come to tonight's class. So just how you came tonight, click on that same link. In about 24 hours, and you'll be able to see a recorded version of this class. Now, tonight, we're going to be talking about moving average convergence divergence, or shortened as MACD. And it is one of my favorite indicators. Now, the thing about it is, I've tried to do this class, I've done this class a lot, and the fact is, it's very wordy. There's no way I can get around it because I need you to fully understand each line that you put on a chart for MACD, where that line comes from, so that you can start using your own abilities to analyze the indicator. And MACD has a lot of lines. They're not complicated. It just takes me a lot of words to explain because it's an indicator of an indicator and it's a four-step divergence from price. So we're going to go through this step by step. But I want to explain to you now, I've tried to do this in every which way, shape, form I can to make it less wordy, but I can't get it down. So bear along with me, and we'll try to get you through this, but I just need you to get this good understanding of exactly how this indicator works and where all the lines come from. Now, it was originally developed by Gerald Arpel in the late 70s, and it was originally developed for the stock markets, because that's what we were trading in the 70s. But it's been adapted by Mr. Arpel many, many years ago for Forex and CFDs. And it is now one of the most popular Forex indicators used in the market. So like I said earlier, the letters MACD is an abbreviation for Moving Average Convergence Divergence. The MACD indicator, which requires moving averages as its input, falls into a group of the lagging indicators. And if you don't know the difference between lagging and leading indicators, lagging tell you when an actual reversal has happened or a rebound, and a leading tells you one should be happening. So lagging are more reliable. So the basic function of the MACD Forex indicator is to discover new trends and help identify the end of current trends. There are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods around this trading indicator, which you can do also, but you first have to understand all the basics before you try to customize it and make it your own. Now, trading divergence is a very popular way to use the MACD histogram. And the last part of this tonight is we'll be talking about the histogram. And it is the fourth divergence of the indicator. And it's really the summation of all the lines that put this indicator together. So the MACD indicator is typically placed on the bottom of your trading chart in a separate window beneath the price chart. The moving average convergence is a relatively easy to use tool. However, it is crucial to understand it fully before attempting to use or trade from its signals. So you have different indicators. Some are placed directly over your chart, and we're going to start with those which are moving averages, and the MACD is placed below. And the MACD signal line, it consists of two lines called the signal line and the MACD line. And then the difference between these lines becomes this purple histogram. Now in this screenshot, it's in purple. We're going to use blue and reds and greens for class tonight, and you can set them any which way you want. Any colors that you feel comfortable with, just so you know which one's the signal line and which one's the MACD line. That's it. But we'll explain that as we move on step by step. And we're going to start off here at the very beginning on a chart. Okay. Now the concept behind the MACD is fairly straightforward. Essentially, and this is the first lines we're putting on the chart, it calculates the difference between an instrument's 26 and 12-day exponential moving average. Of the two moving averages that make up the MACD, the 12 EMA is obviously the faster one. Okay. The 26-day is the slower. Why? Okay. Well, if you were using a 26-day moving average, it would go, and remember, we use the word day because originally everybody used daily charts. Well, we see if you're using a 15-minute chart, instead of being 26 days, it's 26 15-minute bars or 15-minute closes. If you're using a 1-hour chart, it's 26 1 hours. Okay. Now, if you were going back 26 periods or 26 time frames to get an exponential moving average, which is kind of like a weighted moving average, just gives a wee bit more value to the most current price. But when you're using a moving average, you're simply taking the last 26 period closes, adding them together, and dividing by 26. When you're using the second line, which is your 12-day, you're going back to 12 periods, adding them together, and dividing them by 12. And that gives you your 12-period moving average. So the 12 period is a lot more responsive and a lot faster than the 26. Why? Because 12 is a lot shorter than 26. So if you're looking at a move in price and you're looking at a 12-period moving average, it will respond in that moving average because you're only dividing that by 12, where when you're looking for a 26 periods, even though it's got the same price for today's move, you're dividing it all up over 26, so it eases it down. So The 26 is a slower moving average, and a 12-day is a faster moving average. And this is a concept you should understand, because it's also the same concept that's involved when you're using multiple moving averages in trading systems. Now, what we need to do is we need to go to a chart, and we're going to go over, let's go to a live chart, and we're going to put a 12 period and a 26 period moving average on a chart. So hold on, let me pop up a chart for us. Now, once you get all this, you'll never have to do these calculations to put the lines on, because MACD is such a popular indicator. It's done for you already. But the fact is, you have to know where these numbers come from so you understand them. So what we would do is we're just looking at a Euro-US dollar 1 hour chart. We're going to go over here and we're going to go find moving average. And we're going to use a moving average exponential. And we clicked on there. And now we have it on the chart. So I'm going to change this line from a wishy blue to something you can see better. And let's make it a bright red line. And we'll make it a nice thick line. Now, we need to have what? Well, this is our faster one. So we need to have a 12 period moving average on using the close, and we already clicked on exponential. So now we have our first moving average on the chart. Now we need to put a 26 period moving average on the chart. So we're going to click back to indicator. We're going to go back to moving average. And we have a blue one again, and we're going to go up here, and we're going to make that a 26 period moving average. And we're going to take this and let's do let's do a gold. Do a dark gold since that's the ETX color. And so what do we have on our charts? We have two simple moving averages, or exponential moving averages, two very easy lines, a 12 period and a 26 period. Now this is the first step in a MACD indicator. Now, if any of you have noticed MACDs before, when you put them on a chart, they're all below. They're not. You don't see any moving averages. There's nothing dropped on the price chart. Why? Because we're only using these two moving averages for a calculation to put on our MACD that's going to be dropped on our chart. So let's go to our next step. And that is coming up with what's called the MACD line. So let's go back over to my PowerPoint. Now, on the MACD chart, we also have, before we get to that, we have a 9-day moving average of MACD itself is plotted well, and it's a trigger for buy and sell signals. So the first thing we put on here are our moving averages, just like we see on this diagram right here. And then it's converted to what's called the MACD line. The moving average is used to construct MACD, can be very simple, weighted, or exponential. Although they all work, exponential is preferred. That was the EMA that we put on our chart. The MACD is perhaps the all-round best indicator. Now, what we do is we take these two lines. Now, before they're lines, what are they? They're numbers. And to make the lines, we plot each number or each moving average on our chart, and we connect those dots together, and we get those two moving, or we get a moving average, and we connect the dots to the other, and we get a second moving average. Those are all periods in time. Now, in order to get what's called the MACD line, we subtract one from the other. Let me get my marker off of here. So what we do is we take the slower and the faster moving averages and subtract them. Now what happens in downtrending markets, the faster moving average will move down faster than the slowing moving average, like I explained to you before. As the fast moving average diverges from the slow moving average, MACD will illustrate the relationship. So we take, let's go back to the charts. We simply take these two lines and subtract them from each other, and we plot them down below and below the chart here. I'm sorry, let me show you on a marker here. So down below we draw a zero line. From the zero line, we take the difference between the two moving averages and plot them above and below the moving average. When one crosses the other, it would be positive. When the other crosses below, it becomes a negative number. And we're just simply plotting these above and below the moving average on our chart. And this is called the MACD line. So let's show you this. So let's go down here and put MACD on the chart below. And what we have here is we have, so we have the MACD line and the MACD signal line. We haven't gotten to the MACD signal line. So we're going to make the MACD line a dark blue, and we'll make it wide so it's easy to see. And if you notice right on here, this is the zero line. This MACD line is now simply the difference between here and here, and is plotted as the difference right here. And each time it's one subtracted from the other, it's plotted on here, plotted on here, plotted on here. Okay. Now, to show you this so you can see it better, what happens when the 12-day and the 26-day moving averages cross over? What would the 12-day minus the 26-day be at the point that they cross over on the chart? They would always be zero because the numbers are equal. When you come down here, what happens at the crossover point? The MACD line is at the zero line on your chart. As they separate here again, whenever you have a crossover, they're always going to be at the zero. So as they raise and they separate, they would get higher, or as they separate and get lower. So here we can see that our 12-day, our shorter moving average, is below our 26-day. So what's happened is it's becoming a negative number in the subtractions when we're subtracting. When it moves above, it goes back into the positive territory, and so when we're subtracting them from each other, we're getting a positive number. So all of a sudden, we no longer need to have the moving averages on our charts, because all they are is a numeric calculation that is then represented in this blue line down below. See, because otherwise it was just simply a moving average strategy. But we are defining this moving average strategy and giving a lot more to it than a simple strategy. So right now we have this blue line on the bottom. That's all we have right now. Now we go to the next derivative. And this is called the MACD signal line. And in this case, it is the orange line right here. We're going to make this a little bit easier to see, a little bit broader. And let's get rid of this histogram. We'll make the histogram. And we're going to make this a bright red. Now, this bright red line that we just created down below, which is called the MACD signal line, is a derivative of the MACD line above. And it is a 9-period, it's calculated based on a 9-period EMA, exponential moving average, of the MACD line above. So what we're doing is we're taking each one of these numbers that make up this MACD line, adding 9 periods back together, and plotting it on another line, which becomes our MACD signal line. So now we have a derivative of a derivative of a derivative. And what do we have? We have now what's called the MACD line and the MACD signal line. Now these two lines together start telling us a whole bunch of information. Because when one crosses over the other, it's giving us buy and sell signals. Because now we have the slower and the faster calculated into the MACD line, and then we have it recalculated or weighted into an average of 9 periods to form the MACD line, the MACD signal line. And when that MACD signal line crosses above or below the MACD line, it is generating buy signals and sell signals. That's the first thing. There are also ways, because it's called convergence and divergence. We also have divergence when we see higher highs and higher lows of the MACD signal line that diverge. So here we see that the signal line is still going down, but we see the prices moving up. So we have what's called divergence. But we'll get to that in a minute. It's how you use these lines. So now we've gotten rid of the moving averages above. It's plotted in the blue line. The red line is now a derivative of the blue line. Now we're going to go one step farther than that. What do you think the difference between the red line and the blue line, the MACD line and the signal line, will be when they cross over? Again, they would be 0. So therefore, we still have that same 0 line plotted on our chart that we've been using for everything right here. So if we were to take the difference between those two lines, we could plot that below on the histogram, and that would tell us 0. When the MACD line moved above the signal line, you could see that rise in the histogram because they're widening and broadening. You can see them falling below when the MACD line falls below the signal line. Again, when they almost cross over here, you see it at the 0. And so what the histogram is a visual representation of all of these numbers we've plotted in to get this on a simple little histogram down here that takes in and tells you everything that you've got to be looking at. Now, we could simply remove the two MACD lines, and everything we needed to see from all of those things we plotted is contained in this histogram. Except we need those two lines to also help us with some other trading strategies. So even though I got rid of them, we still need to have them. But all of their information is contained in that histogram. And the histogram is a derivative of a derivative of a derivative of a derivative. So it's 4 steps removed from the actual price action on a chart. So I told you in the very beginning this would be very wordy, and I'm sorry about that. But let's go back to my PowerPoint, because now we're getting almost past everything we have to do to actually understand what this is on a chart. But like I said, you need to have a good understanding of what you're looking at on your chart, so that you know how to use it. So MACD can be very helpful for noticing potential trend changes at very early stages of a currency pair's move or a commodities move. However, if we wait for the 0 line crossover, that means the MACD to cross the 0 line, we are essentially trading moving average crossovers, which is inherently lagging the market and may not be the optimal point for entry. This is where the signal line comes into play. The signal line is simply a moving average built on the value of the MACD line. By default, the value is commonly set at 9 periods. So remember I told you we use a 9-period EMA to get that second line on the bottom to make the signal line. Building on the relationship of the MACD line itself, traders will often look for entry points when the MACD line crosses the signal line. So in other words, when they cross over, it gives you an entry point to the market. Or if you're looking at the histogram, when that histogram is at 0. When the MACD line crosses above and over the signal line, it is looked at as a signal to buy. When the MACD line crosses below the signal line, it's often looked for a signal to sell. So in other words, when the MACD line moves over the signal line, it's a buy. So what is that? That is when you see this peaking up here. So when you see it cross over at a 0 and peaking upwards, it's giving you a buy signal. When you see it coming down and breaking below the 0 and coming below the 0 line, it's giving you a sell signal. Okay. But this is a little bit misleading. It gives you these signals, and these signals are reliable. Except, what doesn't it tell you? What haven't we talked about? We haven't talked about how often it generates the signals, how much that signal is, and whether you should trade that signal, because MACD would generate a lot of signals for you. It'll generate a lot of buy and sell signals, but it doesn't tell you how many pips you're going to get, okay? And it doesn't tell you how it's going to fit in your risk management strategy. It's just saying it's going to go up now or it's going to go down now. Okay? So it's going to only be one part of your trading decision, because it does generate a great deal of trading signals. And unfortunately, they're not that they're erroneous. It is that they are not, there's no guarantee of how many they're going to issue and how profitable they will be. And when you got to cover the spread, and it can jump up and it just be a couple points. MACD was completely right. The asset went up and went up, several points, gave you an entry point or buy point, but it wasn't enough to make the trade worthwhile. So in an effort to more closely follow the relationship between the MACD and the signal line, traders can follow the histogram, which is simply a bar chart plotted around the 0 line to indicate the relationship between the MACD and the signal line. Notice in the graphic over here, when the MACD crosses the signal line, the histogram will appropriately cross the 0. When MACD crosses up and over the signal line, the histogram will climb above the 0. And when MACD crosses below the signal line, the histogram will drop below. So the histogram is a visual picture of all 4 of these derivatives put together in one final clue to look at. So you can either watch the histogram or you can look at those 2 lines. But if you're really experienced, you can tell everything right in the histogram. Now, once you have all of this plotted on your charts below, there are 3 different ways you can use MACD for your trading. Okay. MACD proves the most effective in wide swinging markets. There are 3 popular ways to use the moving average convergence and divergence: crossovers, overbought and oversold conditions, and divergences. Okay. Now, crossovers are the easiest. Crossovers are simply when the MACD line and the signal line below cross over each other. Okay. When they cross, and they cross above, they give you sell signals. When they cross below, it gives you a buy signal. So in each one of these cases, you can see right here, the MACD gave us a signal, a sell signal. Prices fell. MACD gave us a buy signal. Prices went up. MACD gave us sell signal, sell signal, sell signal, buy signal. But the fact is, in a lot of these cases, they were completely right, but there wasn't enough movement for you to make any profit. Okay. In fact, you would have probably seen a little bit of a loss when you covered your spread. But if you also look at the histogram, you can see that there was very little movement between the MACD line and the signal line also. Here we had a huge drop. You would have gotten a very good trade in here. Here where you had a small climb, you still had a profitable trade. So it's giving you a very good picture of how the market is moving, but it gives you a lot of signals. Okay. The basic MACD trading rule is to sell when the MACD falls below its signal line. Similarly, to buy, the signal occurs when the MACD rises above its signal line. It is also popular to buy and sell when MACD goes above and below 0 on the histogram. So once again, you can see this in many, many charts. It's a very easy to follow rule. Okay? It's not a complicated signal. Okay? It's how to use it. It's just giving you a buy and sell signal. You need to factor it in with other types of technical indicators. Now, the next way that you would use MACD is as an overbought or oversold indicator. And this is one of the reasons we keep the two lines, the signal line and the MACD line, on the charts. We don't get rid of it, like I said, because we need it for other things, because the histogram can't help you with this necessarily. When the shorter moving average pulls away dramatically from the longer moving average, i.e. the MACD rises, it is likely that the symbol is overextending and will soon return to more realistic prices. So what we want to do is look at the difference in the movement between the MACD and the MACD line and the signal line. When they pull away dramatically, okay, it's telling you that that asset you're looking at is overbought or oversold. It means it's overextended. Now, remember your definition of overbought and oversold. Doesn't mean the market is going to reverse at that moment. It's just telling you there's too many buyers or too many sellers in the market and should come tumbling down. And it's not going to tell us how fast, but the steeper the lines are, the more powerful the difference will be. But then the most useful of the other indicators outside the buy and sell signals, because I don't use overbought and oversold for anything to begin with. I don't use RSI as stochastics in my trading. It's just not something I do. But now becomes what's called divergence. And most people mix divergence up. They think convergence is when the two lines cross over coming together, and divergence is when the two lines pull apart. But it isn't. Okay, not the MACD and the MACD signal line. Divergence is when the MACD line moves in the opposite direction of price. So if you notice down below, we're looking at the MACD signal line, and the MACD signal line, if we were to put a line across from the lower lows to the next higher lows, or what would be called, you could actually call them swing lows, you would see that the price, or the MACD line, MACD signal line, is basically moving in a slow uptrend because it is making higher lows as it moves forward, while price is making lower lows because price is falling. So what we have is a bullish divergence because we have higher lows in the MACD signal line and lower lows in the price. Okay. We can use this as a crossover right here, and we get an excellent breakout or a bullish divergence signal. So when we could plot this on it, we would see that this, what it's telling us is that downtrend is over and would help us enter into or see the market reversal. So an indication that an end of the current trend may be near occurs when the MACD diverges from the symbol. A bullish divergence occurs when the moving average convergence divergence indicator is making new highs while price fails to reach new highs. A bearish divergence occurs when the MACD line is making new lows while price fails to reach new lows. Both of these divergences are most significant when they occur at relatively overbought or oversold levels. So we are using all three signals in this point because we're looking at a signal line crossover, we're looking at higher lows, and we're also looking at overbought and oversold indicators because look at the huge jump in price here. And so we have three completely different parts of three of the different stories that we're getting from MACD all coming together to give us one program. But you notice with MACD, nothing here tells you about momentum, how big the move is going to be, what point you should actually enter the market, and what point you would exit the market. So it's simply giving you buy and sell or trend reversal signals. Nothing with a MACD helps you make an actual entry decision, stop loss decision. So you have to be aware of that. So you need to combine it with other indicators. But when any of these occur, MACD is very, very reliable. So let's go back and let's break down these derivatives again, because the histogram is the final result of the four derivatives. So what's the first derivative? And what is, if you don't know what a derivative, it is a moving away from the ultimate calculation. The ultimate calculation was the price action. So each step that you calculate away from the price action is called a derivative. So the MACD histogram is an indicator of an indicator. Now, in fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. In other words, it is a fourth derivative of price. So what's the first derivative? That's the 12-day and the 26-day EMA. So we started out originally putting us on our price chart. Then we calculated the MACD line by taking the 12-day moving average minus the 26-day moving average and plotting that in that red line that we put on our chart below. Then we got our third derivative, which is the MACD signal line, which is the 9-day EMA, exponential moving average of the MACD. That was the blue line we put below, the signal line. Then we took the MACD line less the MACD signal line and plotted that on the histogram. So it's 4 steps away from the price. The base for the indicator is, of course, the asset's price. It takes 4 steps to get from the actual price to the MACD histogram. Now, you talk about massaging data. Well, not necessarily a bad thing. Chartists should keep in mind that when analyzing with the MACD histogram, it's an indicator of an indicator. Therefore, it's designed to anticipate signals in MACD, which in turn is designed to identify changes in price momentum of the underlying asset. So, as with MACD, the MACD histogram is also designed to identify convergence, divergence, and crossover. So you can see everything within this MACD histogram. Okay. The histogram is positive when MACD is above the signal line. Positive values increase of MACD diverges further from its signal line. The MACD histogram crosses the zero line when the MACD crosses below its signal line. The indicator is negative when MACD is below its signal line. So eventually you should be able to look at all of this and see everything. You see converging, you see diverging, okay. You see crossovers, and you can see overbought or oversold. So everything is ultimately contained in that MACD histogram. So with time and experience, all you're going to be doing is looking at the histogram. Now, let's talk about what we're calling transaction signals, the buy and sell signal, and that's what everybody's looking for. They're looking for indicators to tell them when to buy or sell. So it's become standard to plot a separate moving average alongside MACD, which is used to create a clear signal of shifting momentum, which is the MACD signal line. A signal line is also known as a trigger line. So keep in mind that signal line is your trigger line, and it's created by using the 9-period moving average, which we already talked about. Okay. So when that signal line or trigger line crosses above or below the MACD line, it is generating buy and sell signals. Okay. The basic bullish signal, the buy signal, occurs when the MACD line, the solid line, in this case, crosses above the signal line. Traders who attempt to profit from bullish MACD crosses that occur when the indicator is below zero should be aware that they are attempting to profit from a change in momentum direction. While the moving averages are still suggesting that the security could experience short-term sell-offs. This bullish crossover can often correctly predict the reversal in the trend, but is often considered riskier than the MACD were above zero. I'm sorry. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change direction quickly. The large number of false signals can result in a trader taking many losses. When commissions are factored into the equation, this strategy can become very expensive. So like I said, it will give you a signal, but that signal is keep in mind, is a buy and sell alert. You need to calculate, can I trade this? Is it going to be a significant enough move? You need to use other things, just saying, it's telling me to buy, so I'm going to jump in the markets and buy now. So another MACD drawback is its inability to make comparisons between different securities. Because the MACD is the dollar value between two moving averages, you cannot use it to compare the euro pound and the euro US dollars at the same time. The MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transactions help minimize the subjectivity involved in trading, and the crossovers of the signal line make it easy for traders to ensure that they are trading in the direction of the current momentum. Very few indicators in technical analysis have proved to be more reliable than MACD, and this relatively simple indicator can quickly be incorporated into any short-term trading strategy. So if there were ever a quest in the world for investing with the search for the Holy Grail, it would be by acquiring the ability to spot trend changes. There are many ways investors attempt to do this with varying degrees of success, but a common trend tracking tool is a two-line moving average convergence and divergence. This tool measures an asset's momentum and can aid investors in spotting changes in market sentiment. So remember, just like in physics, momentum changes occur before the price of an asset changes. Now, there's all different ways that you can start using and do further interpretations of MACD, channeling with MACD. Okay, looking for the price channels. Just like you look for channels on your price chart, you can look for channels in the MACD indicator. But the strength of the current trend can be measured by channeling the MACD. You can spot trend reversals for looking at divergence in momentum, okay, and determine buy and sell signals. But remember, like life, trading is rarely black and white. Some rules that traders agree on blindly, such as never adding to a loser, can be successfully broken to achieve extraordinary profits. However, a logical, methodical approach for violating these important money management rules needs to be established for attempting to capture gains. In the case of the MACD histogram, trading the indicator instead of the price offers a new way to trade in an old idea, divergence. Applying the method to the Forex market, which allows effortless scaling up of positions, makes this idea even more intriguing to day traders and position traders alike. So MACD offers you lots of choices and abilities. First, you have to learn to put it on your chart. You have to learn how to read those lines. You have to learn how to look for entry and exit point, or buy and sell. Learn to look for crossovers. Learn to look for a divergence. Then you can incorporate into your trading system, and you can find, and there's huge amounts. If you just look up MACD, and Joe Arpel, the original developer, has a whole website that it keeps expounding on the strategies and different ways you can use this. It's a great, reliable indicator. You can start out with very simple uses and keep adding more and more onto it. It can become one of the main ways that you spot entry and exit points. Then you just have to use maybe support and resistance, maybe GAMFANs or Fibonacci numbers to be able to predict how far or whether you should be entering a trade and what kind of profit and loss, because you should always be calculating your risk and money management and to see whether you can make that trade. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. Have a great trading day and enjoy the holiday season. Good night now. And watch, we're about to post a January and February schedule. We have a whole bunch of new classes. In fact, we have 12 new courses coming up for January and February. So you're going to have a nice, exciting winter season with new classes. So have a great weekend, or have a great week, and have a great holiday season, and we'll talk to you again real soon. Good night now.